Welcome to Better Vantage by Vanguard, a podcast series hosted by custom content from WSJ and Vanguard. In this podcast series, we'll be talking about the topics that are top of mind for financial advisors and investors today. In each episode, we'll be sharing market insights, data analysis, and strategies to help you invest with greater conviction. And with me is our co-host, Joe Davis, Vanguard's Global Chief Economist. Joe, hello.
Hello again. Exciting.
And of course, our special guest today is Chen Wang, who is the Chief Economist for Asia Pacific and Global Head for Capital Markets Research at Vanguard. Chen, welcome.
Great to be here.
I've had the pleasure of working with Chen for years. We work together in investment strategy group, and I think the listeners should be really excited because, not very often we can, talk to someone, an expert that has both a deep macro background, but also really responsible for modeling, thinking about the risks and the opportunities in the capital markets. Certainly my job today for our podcast listeners is they have a better understanding of what they could be getting into or if they're staying the course on their non-U.S. investments, which have trailed for some time.
So, Chen, let's start there. So, international stocks have been lagging U.S. stocks for pretty much since the GFC. Can you explain this long reign of U.S. stocks?
When you look at the past decade, right, from 2014 to 24, the U.S. markets returned about 13.1% on average, over the past decade. This really outperformed the international market by 7.7% every year in U.S. dollar
huge.
terms.
That's
huge,
that's
right?
amazing.
So I would say most of that is indeed driven by fundamentals, both at macro level and micro level, right? So if we use the, sum of parts approach to decompose the returns, right, you see that comes from strong earnings, strong, valuation expansion, and also strong U.S. dollar, right? So we see that 13% annualized return. Now, I would say actually slightly over half of that come from stronger earning growth, right? So now, of course, at the macro level, you could say, look, U.S. really enjoyed pretty decent, solid economic growth. Interest rate is low, and tax rate has been declining, right? Now, but I think more importantly is actually at the micro level. The corporate fundamental is really, strong, right? U.S. companies are just much more productive in value creation. One measure we use is ROE, right? Return on equity. That's a standard measure of corporate productivity. It just shows how good a company is, generating profits from their capital. Now, U.S. companies just does that so much better compared to their international peers. Now, what's more is also those high ROE companies, they also retain and also reinvest their earnings more, even though that will lead to lower dividend yield, right, for some investors. But then when you invest them in a high rate of return, then they could actually grow earnings even faster, right, further down the road.
If I have it right, what you're saying is, listen, there's generally three broad buckets that can contribute to, in this case, the U.S. and all other equity markets as a group, non-U.S. markets, from outperforming or underperforming. One would be the earnings growth, the fundamentals you mentioned.
Right.
There could be currency effects that could either make non-U.S. companies less valuable. It's the value of the U.S. dollar. And then the third one is the valuation. It's the price paid. So you're saying it's along all three dimensions, the past decade, all have pushed in the U.S.'s favor versus the non-U.S.
Yes. Yeah. Yes. I mean, we talk about earnings, right? And the other part I think is just amazing to see is how valuation has expanded over the past decade. I know a lot of people are saying that U.S. market is very expensive now, and especially compared to historical average. Now, to be frank, I think that's a wrong benchmark to use, right? I mean, in the long run, stock price should converge to their business fundamentals rather than a simple stats, right? We believe that, valuation is actually time varying and should be a function of both the macro and business fundamentals. I would say a lot of the valuation expansion was justified by a low interest rate and low inflation environment, right? Now, even though we saw that Fed has been tightening monetary policy over the past several years. But you know what? U.S. companies, especially those large ones, they are able to lock in to low borrowing costs through the corporate bond market, right? What we call the rate lock effect. Now, I would say that's very different from a lot of other countries like Europe, where the financial system is primarily dominated by banks and that they are able to adjust the interest rate much higher, much faster. I think the question is whether the expectation is reasonable or too high. We can discuss that later.
Yeah, sure.
The other reason I think for valuation expansion is that, just as we mentioned earlier, right, when you have very productive companies, right, in generating earnings, now, it's reasonable for investor to expect that they are going to have higher earning growth in the future. Now, Joe, you also mentioned about U.S. dollar.
Yeah.
Now, because I think we now talking about return in U.S. dollar terms.
Yeah.
Right? So, in fact, I would say international market has pretty decent return, in their local currency terms. Take Japan as an example. Ever since 2012, the local currency return in Japan market, guess what? 12.6%. You're like, oh, that's not much lower than
not much
US.
different from the U.S.
But in US dollar terms, 7.6% only. Right? So I think this U.S. outperformance really benefited from
which
a
some call
strong
U.S.
decade for US
exceptionalism.
dollar.
I mean, investment circles, that's
Right.
what some refer to as U.S. exceptionalism, which means the U.S. having
Exactly.
outperformed.
Right? So when you think about U.S. dollar, number one, U.S. dollar really started last decade on the weak side, right? And then, higher productivity that support the stronger U.S. dollar. And also, surprisingly, we talk about low interest rate, right? But relative to the world, it's actually not that bad. Think about Europe and Japan, where interest rate is 0 or negative. So all those things support the U.S. dollar appreciation, right? And then the strong performance of the U.S. market actually attract international capital, and that further support the U.S. dollar. So it's kind of virtuous cycle between the U.S. market, asset market, and U.S. dollar.
International stocks are outperforming U.S. stocks. Is that all about the tariffs, or are there market fundamentals overseas that are working in their favor?
Mm-hmm. Now, I would say, Christine, there's a lot of going on this year, right, other than tariff. When you think about long-term market returns, it really depends on how the secular macro outlook evolves and also how the business corporate profitability trend will evolve. I think at this moment, our outlook for the next decades is that we will say the chance of risk is actually tilting towards international outperforming, right? We use our model, forecasting model called VCMM, Vanguard Capital Market Model. It's actually utilizing a probabilistic framework that our forecast is a distribution, not just of point forecast. It's a distribution based on, 10,000 simulation of the future. Now, I would say at this moment, out of every 10 simulation, international will outperform in 7. Right? So if you look at the median of the distribution, we are expecting U.S. Market to return about 4.3% every year over the next decade, while international will give you about 6.1% for the next decade on average.
So you're saying on average,
Yes.
1 or 2% return premium potentially
Right.
for U.S. investor, right? For non-U.S. over U.S., but that's not a foregone conclusion.
No.
Roughly 70%.
No, we say 70% chance that international will outperform in the next decades. Now, of course, that means, maybe you have 30% chance that U.S. could still outperform. But this is where we really want to emphasize on the global diversification. If you have the right time horizon, risk appetite, you may want to slightly overweight international, right? But diversification is always our first and foremost investment principle.
Well, full disclosure, and just from a mea culpa perspective, we've been saying, Vanguard's been saying, our investment strategy group has been saying that those odds, the 70% odds that Qian mentioned, that we would have said, or did say the same thing 4 or 5 years ago, right?
Mm-hmm.
So I'd say, those that want to be kind say, oh, we're early, because
Yeah.
what you were saying, Christine, right? I'd say you could also say we were wrong, but it's why were you wrong? And I think, Qian, maybe you could talk a little bit about, what are some of the assumptions or the conviction, right? You have a deep
Right.
research team. You're looking at these things all the time.
Over the years, we actually have been continuing to build on our, time varying fair value model, right, for the valuation. In the past, we always say valuation is a function of the macro environment, right? Low interest rate, low inflation, and low volatility should support a high valuation. Well, then later we actually, improve the methodology. We realized that, no, it's not just the macro, it's also the micro, right? Business fundamentals, right? Like in the U.S., the growing weight of asset-light, high ROE, technology companies could actually sustain higher valuation, right? Because you are more effective in your value creation for investors, right? And you invest more, right? So you actually get a higher, potentially higher earning growth in the future.
Christine, where I'm going with this for listeners is if you're going to do forecasting in markets, you got to hold yourself some way accountable, both when you get it right and also when you get it wrong.
Right.
And but I'm really proud of the process, Chen, you have. But I think good active managers do that because you learn from. You just want to make sure the process is strong.
Totally.
Right?
I think Joe, first step for improvement is really to admit that we were wrong. Right. There's no denial here. Right. But I think one thing is that we have to recognize forecasting. Is a very important tool for any household, for any individual business who need to prepare and plan for the future, right? So it's that job we must continue to do. But then the thing is, how can we do better, right? I mean, when we talk about this, forecasting, this principle, valuation is the most important driver for long-term return. That we didn't change, right? We don't change that, right? Because driver for equity return can be very different across different time horizon.
The other thing, but to keep me honest here, Jen, I also think about it from a risk management perspective, and where I'm going with that from my macro background. There's two things that I would worry that if I had all of my eggs in the U.S. equity market. One would be I think that's a bold assessment that all of the largest companies that may drive, I don't know, half of the returns over time. They're very small, Christine. There's what, 2%, 3%, 4%?
Yeah.
You could tell me what number. That they're all going to be based in the U.S. The other one is, what's not in the U.S. record, but it could be, and I'm not saying it will be in the future, and that is downward pressure on currency, in part because of our fiscal issues.
Yes.
I would always worry if someone has 100% exposure to simply U.S. Their stock market returns are all denominated in U.S. currency that you were talking about. That's just from a risk management. If there's other fundamental reasons why, from a risk management, why you'd want some non-U.S. exposure.
So Chen, you talk about U.S. stocks being overvalued. And despite all the calculations that you talked about, it is still overvalued. Is that enough to encourage people to diversify? It feels like there's a reluctance there.
Yes.
Where is that coming from?
Valuation is not the only thing, right? And then when we think about return, Joe just said, U.S. dollar, right? We do think U.S. dollar actually is coming back to our fair value estimate. So it's no longer a tailwind for U.S. investors.
Oh, interesting.
Right? And then there could be still room for further depreciation if global investors decide to diversify away from U.S. dollar assets, right? So to summarize that, our outlook is that we still expect international companies to have lower earning growth, right?
Relative to the U.S.
Relative to the U.S., right? There is where you talk about business fundamental. I would say the U.S. companies still enjoying that, stronger business fundamental. But on the other hand, international companies, they have more reasonable valuation, higher dividend yield, as well as, less, potentially some U.S. dollar depreciation becoming their tailwind.
Oh, interesting.
Now, talking about Christine, where's the pushback come from? Recency bias, right? But people still look at the, past decades saying that, U.S. actually had such a stellar decade. Why would I want to bother to buy non-U.S. International market? Now, my point is that, now look, if you drag the history even longer, U.S. actually underperformed the non-U.S. developed market in 3 out of the last 5 decades, 70, 80, and then 2000.
I want you to put on your active manager hat. You got your macro hat and you got your capital markets research hat. So maybe if you'll stick with me here, just do a speed round. I'll ask you 3 quick questions, one or the other market. If you had to overweight them over the next, 3 or 5 years. I'll pick some non-U.S. markets, all right? Europe or Asia?
Europe.
Developed or emerging?
Developed.
China or India?
I would say neither.
Neither. All right, so
I have some serious reservations for both.
Oh, see, all right.
Why not China or India?
Well, I think, when I look at the emerging market in general, right, and we follow the same framework that we just talked about, right, valuation, business fundamental and currency, things like that. China and India are very different stories. When you look at China, valuation is pretty low. That could be their tailwind, right, for the next decade, right? Because if you look at the current valuation, it pricing a lot of the negative news already, right? Structural headwinds, housing, and also, geopolitical risk, right? That already priced in. So you're like, okay, what could be even more negative than this, right? But then again, never use valuation as a timing tool. right? It can't, market can't stay overvalued or undervalued for a long time.
I remember Japan.
Right. The question is, what is a catalyst that can turn around this, right? So I know at the beginning of this year, a lot of people were very excited about AI, right? And then you would be very impressed by China's innovation and manufacturing. But on the other hand, my biggest issue with China market is that how do you translate the macro story to the micro story, right?
Tell me more.
So
what do you mean by that?
When you have innovation that can sustain your productivity, right? And this is where you can actually lift up your supply capacity and then, long-term trend growth, right? So Joe, by the end of the next decade, I see China as a 4% economy rather than 3% economy, right? Because of the innovation production. The problem is that the consumption and demand is too weak. When you have so strong supply and a very weak demand, what you end up with is deflation, right? Low nominal growth. And that means the corporate earning growth is going to be very weak, right? You have no pricing power. Where do you get the profit? Right. So I think that's where I'm a little bit more concerned about China's micro story. Now, Indian, I love the macro story, right? The macro story, a lot of us say this global outsourcing of manufacturing, service, right? And they are catching up really quickly. The problem is that it's probably very expensive already. I think, being a researcher for the capital market is not just about being a macro, right? Look at what's going to happen in the future, right? Where is a breakthrough? For example, we talk about Europe, defense spending, right? Defense spending. There is a way that you can use this to boost up long-term, productivity, right? Defense spending, you put that in a lot of public R&D, and they can actually crowd in private investment rather than crowd out. Right? So you just use that in the right way, right? So I think there could be some hope for the European market. Japan, lost decade? No, lost 3 decades, right? No, well, to a certain extent, the last decade was pretty good for equity investors, right? Especially in local currency terms. But I think when you look at Japan, I think what we have is a return to normal inflation. I'm not even saying high inflation, just 2% inflation.
Listen, you sold me. I don't need to be sold. But for the listeners, what about, so you're talking developed markets, Europe and Japan or Asia, right? They may be a little bit surprised, right? If in terms of what could lift the equity markets outside the U.S. What about AI in that front?
Yeah.
Because a lot of those countries actually lag there.
We are slightly optimistic, more optimistic that AI could be this transformative. Yeah. If that's the case, it's going to lift up, generate broad economic gains across all sectors and all countries, right?
I got you. So if you're outside the U.S., it could be banking sector.
Exactly. Right. So, Joe, I think this is sometimes people always confuse about innovation, and they narrowly define innovation in the scientific breakthrough. Optimization is also innovation. Application is also innovation.
Particularly if it's transformational. I agree with you, Jen.
Right? Yeah. So then in that case, I would say actually AI is a reason that we believe, other than other, the catalysts we just mentioned, defense spending or corporate governance reform in Japan. I actually think AI is the reason we believe international would outperform. Right? U.S. may actually live up to the high expectation.
So that's fine. That's
but international will catch up.
I love that.
Because of the AI.
I'm not sure where I'm going to bet. I'm going to bet on this, but this has been really great. I love Joe's lightning round, so I want to extend that to as we wrap this episode. What would be the key takeaways?
If anything, I would, take away is remember the diversification, right? Skipping international is not safe. It's really just a concentrated gamble, right? So, diversification is always, makes sense, right? They make sense anytime, any environment, but, probably particularly important at this moment, especially when we are, seeing a better chance for international outperformance. So I know a lot of investors have recency bias, and they have home bias, buy what you use, right? Is what the people are saying. But I think that may not be a rational decision if your objective is to maximize your risk-adjusted return, right? So I would say having some international exposure, starting with the global capital market weight benchmark 60-40, I think that would be a good start.
And I think you've given audience a lot in terms of, if you do have simply U.S. exposure, it's really gone in the favor, and that's been fantastic. But let's get off the zero bound, right? And let's hedge some of those bets.
Yeah.
Thank you so much, Chen. Thank you for making such a powerful case for international diversification. And definitely the message is keep your one foot in the U.S. door, but definitely explore. There are a lot of opportunities out there. Thank you for joining us. If you enjoyed this episode and found it helpful, subscribe and share.